Good morning, good afternoon, good evening, depending, of course, on your location. Thank you for joining Mayor Brown's Global Financial Markets Teleconference Series. Today's call is entitled ESG for Financial Institutions, Where Are We and Where Are We Going? My name is Paul Forrester. I'm a partner in Mayor Brown's Chicago office and a member of the banking and finance practice with a focus on structured credit, energy, and project development. Before we begin our presentation, a couple of housekeeping items. As regular GFM listeners know, our calls are recorded, and we will be emailing an audio link to all participants so that if you wish to listen to it again or share it with colleagues, you could do so. In addition, the recording will also be made available as a podcast on your preferred podcast platform. In our GFM calls, we do not have Q&A sessions, but we certainly encourage you, if you have questions about today's topic, to send them to us by email using the address gfm@mayorbrown.com, and we will promptly respond to your questions. By the way, that is the same email address as was included on your invitation email. Joining me today is my partner, Andrew Olmem. Andrew is a partner in the Washington, D.C. office of Mayor Brown and a member of the public policy, regulatory, and political law practice of the firm. Prior to rejoining Mayor Brown, he served as Deputy Assistant to the President for Economic Policy and Deputy Director of the U.S. National Economic Council, where he oversaw the development and coordination of all domestic economic policies, including financial services. Andrew also served as Republican Chief Counsel to the Senate Banking Committee. With that brief and probably an adequate introduction, we're going to begin our presentation today. Andrew, the Biden administration from day one has made it clear that it supports the use of ESG in not only investment but other business decisions, as well as federal regulation. Can you bring us up to speed on what the Biden administration has done to date on ESG specifically?
Yes, President Biden has been very focused on ESG since the start of his administration. In the first few weeks following his inauguration, he signed several executive orders to establish that both combating climate change and advancing equity, social justice, and diversity are top priorities for his administration. Now, these initial executive orders apply to every department and agency of the federal government, and were not specific to federal financial regulators. And the initial policy focus was really more focused on energy production and the federal government's own carbon footprint. Indeed, probably the most direct impact of these initial EOs on financial regulation is that the U.S. will seek to end the financing of carbon-intensive fossil fuel-based energy projects by international financial organizations such as the Export-Import Bank and multilateral development banks, and shift such financing to sustainable development. However, it was very clear from the beginning that financial regulators are going to play a really key and leading role in advancing the administration's goals of addressing climate change and advancing equity by moving forward on incorporating ESG into financial regulation. Now, we have seen that the SEC start a process to examine how public company disclosures should incorporate ESG, and the Fed has started examining the impact of climate change on financial institutions and the U.S. economy overall. However, the big policy steps are still to come and are in substantial part waiting on President Biden's financial regulatory team to be nominated or confirmed by the Senate. So far, only Treasury Secretary Yellen and the SEC's new chairman, Gary Gensler, have been confirmed. The leadership of the other financial regulators has either not been nominated or confirmed, or their terms of the existing regulators has not expired, giving President Biden an opportunity to make a new nomination. That said, with President Biden signing the EO on climate-related financial risk last Thursday, activity is going to start picking up in the financial sector.
Picking up on the most recent executive order, how significant is it that he's issued this order on climate-related financial risk in particular?
Paul, it's very significant. First, anytime a president signs an executive order specifying the policy of an administration, it sends a clear message that the president is personally engaged on the issue and wants to move forward with a particular policy. And since the president is the constitutional head of the executive branch, executive orders naturally get the attention of all of the relevant leaders and employees at the relevant federal departments and agencies. Now, the EO President Biden signed on Thursday is also significant in its scope and breadth. It specifically establishes that it's the policy of the administration to advance the disclosure of climate-related financial risks, to mitigate its causes, and to achieve a net zero emissions economy by no later than 2050. To achieve these policy goals, the EO directs a wide range of senior government officials, from White House economic staff to several cabinet secretaries to the OMB director, to take a series of actions from conducting specific studies to taking certain regulatory actions. It's common for EOs to set out a policy and then direct cabinet members to implement that policy. But what is worth noting here is that how many different cabinet members are directed to take actions, which clearly is intended to set the groundwork for major actions on ESG going forward.
Well, that sounds like it's something different. What about the details of the EO? What are the key directives that the president is giving?
Sure. Well, first of all, as I mentioned, the EO requires the production of several reports, including by the Financial Stability Council, FSOC, and by the White House's NEC Director, Brian Dees, and the National Climate Advisor, Gina McCarthy, that will further develop the administration's approach, work out really the specific details to incorporating climate change risk into the supervision and regulation of financial institutions and in the federal government's own management of climate risk. Now, the EOs also require some specific actions to be taken by certain cabinet members. Most significantly, first, the Labor Secretary is required to address how climate change risk can factor into investment decisions by ERISA fiduciaries. The DOL has already indicated that it's not going to enforce a existing rule that limits the use of ESG factors in investment decisions by ERISA fiduciaries. This directive is likely to expand on reverse course on that existing guidance. Second, the EO also requires the Labor Secretary to assess how the Federal Thrift Savings Plan takes into account ESG factors in its investment decisions. Third, the OMB director and the NEC director are directed to develop standards to incorporate climate-related financial risks into the federal government's financial management and financial reporting. Fourth, the Federal Acquisition Regulatory Council is directed to consider new rules to require government contractors to publicly disclose greenhouse gas emissions and climate-related financial risks, and to give preference to government contractors with lower greenhouse emissions. And then finally, the Secretaries of Agriculture, Housing and Urban Development HUD, and the Veterans Affairs are to consider how climate-related financial risks should be incorporated into the underwriting standards, loan terms and conditions, and other asset management and servicing provisions of their loan programs, particularly the FHA and Ginnie Mae loan and guarantee products. Now, it may seem that the EO merely requires a lot of reporting and assessing of particular policies. But what is really happening here, and this is critical, is that it's critical to understand what's happening, is that the EO is initiating a series of policy processes throughout the federal government where agencies will develop policies for achieving the objectives set out in the EO, and then report back to the White House on the actions that they have taken or will take to achieve those objectives. You know, there are a few things in the federal government that can generate as much activity and movement towards advancing policies as an executive order that's on a priority topic such as this EO. So I think we're going to see the specific policies on incorporating ESG into financial regulation to come out of this process that this EO has begun.
That's very interesting, but you mentioned FSOC. Let's talk more about FSOC and what it might do in response to the EO. Could, for example, the FSOC take action that would impact regulated financial institutions?
Yes. In fact, you know, the EO directs Secretary Yellen to use her authority as chair of the Financial Stability Council to have the FSOC study climate-related financial risks to the financial stability of not only the federal government, but also the U.S. financial system, and to issue a report to the president on how to implement disclosure of climate-related risks by regulated entities, and how agencies are approaching climate considerations into regulatory and supervisory activities. FSOC is also asked to make recommendations on how climate-related financial risks can be mitigated through new or revised regulatory standards. The report's due in 180 days. Now, in practice, the FSOC report will push federal financial regulators to incorporate climate-related risks into their regulations. And in her remarks on the signing of the EEO, Secretary Yellen said that she intends to use the FSOC to coordinate the implementation of climate change policies with respect to the financial sector. The real question really going forward and left unanswered so far is whether Secretary Yellen will use the FSOC to propose regulations to address climate change beyond what are already being developed by financial regulators. As I mentioned earlier, the SEC is already working on a proposal to require public companies to disclose climate risks and other ESG issues, while the Federal Reserve is studying how climate risk could impact regulated financial institutions and U.S. financial stability, and is looking to have institutions conduct scenario analysis on the impact of climate change on their businesses. However, Yellen has been very clear that she sees climate risk as demanding immediate and very significant actions, including beyond disclosure. In her remarks on the EEO, she said that achieving a net zero emissions economy will require, quote, transformational investments in our energy sector and the broader economy, and the global financial sector will be a crucial player helping channel capital into investments that green our society, end quote. Although she has recognized in an earlier speech that there are significant technical challenges to incorporating climate risk into financial regulation, including data gaps, the long-term nature and unpredictability of climate risks, and the difficulty of translating climate change data into economic and financial projections, she has categorically rejected calls to move slowly due to these technical difficulties, saying that climate change is a, quote, major problem and it needs to be tackled now, end quote. And in her remarks on Thursday, she stated that, quote, assessments of climate-related financial risks may require new perspectives and new tools, end quote. What new tools she may have in mind are the real open question going forward, but it's clear that she wants to move quickly with broad action and likely in ways that haven't so far been discussed as part of the policy process.
Andrew, that's very interesting. But moving from FSOC to the SEC, you mentioned that the SEC is already moving on ESG. What has it done so far, and what might we expect from the SEC even this year?
Sure. The SEC is likely to take the first major actions on ESG by revamping public company disclosures to include additional ESG-related disclosures related to climate change and company workforces. The SEC has already asked its staff to examine its existing disclosure requirements to determine how they could be modified to facilitate the disclosure of consistent, comparable, and reliable information on climate change. This work will include updating the SEC's 2010 climate change guidance. As part of this effort, the SEC has also requested public comment on how public disclosure requirements should apply to climate change, whether they should be modified, and if new disclosure should be adopted. The comments are due next month. The SEC has also said that the Division of Corporation Finance will focus on the adequacy of existing climate disclosures and public filings, while the Division of Examinations will focus on climate and ESG-related risks in proxy voting policies and business continuity plans. In addition, the SEC has created a climate and ESG task force in its Division of Enforcement, which will develop initiatives to proactively identify ESG-related misconduct. Its initial focus will be to identify any material gaps or misstatements in issuers' disclosures of climate risks under existing rules. Going forward, all eyes, though, are on the new SEC Chairman, Gary Gensler, who has said that issuing new rules on ESG disclosure is one of his top priorities, as such disclosures are material to many investors. To date, Chair Gensler has been careful not to get ahead of the rulemaking process by commenting on the specific contents of these new disclosure requirements before they're proposed, though he has said that they should be consistent and comparable, and that they will work to that they will include workforce information such as diversity, part-time versus full-time workers, and turnovers of labor forces. It's expected that the SEC will propose these rules sometime this year.
Thanks, Andrew. What about the federal banking agencies? What are they doing, and what's been their approach to date on ESG?
Well, the Fed has been moving very rapidly to develop its policy on climate change. In December, the Fed joined the network of central banks and supervisors for the greening of the financial system, which is a group of central bankers and bank examiners who are working to share best practices and develop climate and environmental management in the financial sector. The Fed has also established two internal working committees to study the potential impact of climate change. One committee will examine the potential impact of climate change on regulated financial institutions with a prudential regulation, safety, and soundness focus. The other committee will examine the potential impact of climate change on the financial system as a whole with a systemic risk focus. It's important to note why the Fed took this approach to studying climate change risk. Unlike some central banks, the Fed does not have a statutory mandate with respect to climate change. Its legal authority is to supervise regulated institutions to ensure their safety and soundness. And as a member of the Financial Stability Oversight Council, the Fed chair is also responsible for monitoring and addressing systemic risk to the financial system. Thus far, the two committees are divided according to these legal authorities. The Fed doesn't have the authority to go out and directly regulate institutions for the purpose of addressing climate change risk. How the Fed will ultimately decide to proceed with respect to climate change is still up in the air. It has said that banks will need to conduct scenario analysis whereby they estimate the impact climate change could have on their balance sheets and operations. Indeed, Fed staff have been pushing larger institutions to conduct this scenario analysis. This would include how changes in sea levels, flooding patterns, occurrences of wildfires would impact a bank's assets and liabilities overall, as well as specific segments, such as loans to the energy sector. Now, the big question is whether the Fed and other banking regulators will require capital charges for climate risks or incorporate climate change risk into bank stress tests that would effectively set capital requirements. At this point, that is not the direction they appear to be heading. However, it's crucial to note, following up on what I mentioned earlier about the nomination process, Fed Vice Chair for Supervision, Randy Quarles, his term ends in October, and Fed Vice Chair Richard Claridge's board seat term ends in January, and Fed Chair Jay Powell's term ends next February. There's also one open seat on the Fed. Thus, policy at the Fed could turn very quickly depending on how President Biden handles these upcoming appointments.
Turning from the Fed itself, what about other financial regulators? What steps might they be taking or looking to address ESG?
Well, the OCC and the FDIC have indicated that they will begin examining how banks are managing climate risk in their supervisory reviews. They will likely take additional steps as part of the FSOC's process on addressing climate risks. With respect to the S of ESG, actually, the federal banking agencies are also moving forward with respect to proposing new rules to the Community Reinvestment Act, which are likely to happen as early as later this year, and strengthening fair lending enforcement and continuing the ongoing effort to improve access to financial products for underserved and underbanked individuals. With respect to other financial regulators, the Federal Housing Finance Agency has issued a request for information on the impact of climate change and natural disaster risk to the GSEs and the U.S. housing finance system, and how FHFA's supervisory regime should be modified to address these risks. I would also note that the Department of Labor will be reviewing the use of ESG factors in investment decisions by ERISA fiduciaries. As I mentioned earlier, this could be a very significant action as the DOL is likely to increase the flexibility of ERISA fiduciaries to consider ESG factors, even if they materially impact the investment returns of beneficiaries. The Biden Climate Risk EO also asked the Secretaries of HUD, Agriculture, and VA to examine how climate could be included in their federal loan programs. This is one I think didn't get significant attention when the EO was released last week, but for many financial institutions, it's possible that these reforms are the first to be developed and deployed because they are solely within the authority of the administration and officials already appointed who can oversee their implementation. And finally, I'd note that the Biden climate EO also does require the Treasury Secretary to assess the supervision and regulation of insurers with respect to climate-related issues and the risks of major disruptions in private insurance coverage due to climate change. Now, this work is going to be done in consultation with state insurance regulators in an effort by the federal government really to kind of push state regulators to do more with respect to state insurance regulation and climate change.
Thanks again, Andrew. And clearly, a review would not be complete without addressing the role of Congress. It hasn't been sitting on the sidelines. What role might Congress play in advancing ESG policy?
Yeah, Congress is very significant in advancing policy here, but not in the traditional way that one would think in terms of having Congress pass legislation. Congress is focused on the issue. There have been several bills that have been introduced that would mandate disclosure of climate risk and the diversity of a corporate workforce, as well as advance equity in the provision of financial services. However, it's very unlikely that any of these bills will ultimately be adopted because the Senate still is subject to the filibuster. And while many of these bills will be passing the House, it doesn't appear that they're going to have the 60 votes needed to pass the Senate. There's strong opposition on the Republican side, especially in the Senate, on incorporating climate risk into SEC disclosures and corporate governance on grounds that such information is not material to investors and is essentially a backdoor means for credit allocation by the federal government without congressional authorization. However, all this congressional activity, not only on the introduction of bills, but also hearings and the confirmation process is going to be used by Congress to push financial regulators to move forward with ESG, send a clear signal of where they want to go. And many of these bills will likely see portions of them end up ultimately in effectively being incorporated into regulations passed by financial regulators down the road. So Congress is certainly going to be a key influencer of how the ESG will be incorporated in financial regulation. In addition, Congress is also considering major infrastructure legislation that is likely to include substantial funding for projects related to climate change mitigation, such as flood control, renewable fuels research, home energy efficiency standards. This bill will not only provide a lot of money to help with the transition that the Biden administration wants to do from moving away from carbon-based energy to renewable energy. It also potentially could include some additional mandates for institutions that would like to use these funds and participate in these projects to adopt certain climate change or other ESG standards as part of a condition. As I mentioned before, the Biden administration has been pretty clear that it now wants to use the federal procurement process as a way to push disclosures of climate risk and also to advance other ESG policies. So we could see some provisions come out of the consideration of this infrastructure legislation later this year.
Andrew, thanks very much for that terrific review. There's obviously a lot going on, and I suspect we'll be having you back to bring us up to date later as these events unfold. Thank you to our audience for tuning in today. Just a couple of reminders. Look out for the email with a recording of today's call, also to be available on your podcast platform. And as I mentioned before, if you have questions about today's subject, please send them using the email address gfm@mayorbrown.com. With that, our presentation concludes. Thank you again for your participation. You may all now disconnect.